So today we are thinking this is becoming increasingly important. A lot of our clients, I would say a lot because there are really a lot. And when they sell real estate properties, they know how to calculate capital gains, but they never calculate it right because they always forget the other part of the gains, which is recapture gains charged on the regular income tax rate. So today I'm going to break it down for you using an example. At the end of today, I'm going to draw you a chart with where that goes and how taxes was happening and give you a clear picture. So let's get going. And here is our website, communitycpa.com. And you can come over here, look at the top line. We're on board with us. You literally can start uploading, uploading your information at midnight. If you don't have time to talk to us to onboard, you do that, then we will come back to you and getting you properly onboarded. You can also make appointment here with us. These are video calls, video conference calls. You can book the partner's time and then we will come online, talk to you. And there is 30 minutes exploration calls with some partners that is free of charge. But the rest of us, including myself, you come in, you do pay a fee, but you also get the answer that is catered to you, not some general rules that you're not sure whether that apply to you, right? And we have our webinars, all of these kind of things we talk about today, it is going to be on YouTube channel. We deposit them here so you can see that we have like over 1,000 videos in the storage, and you literally can go into here, type what you want to know. For example, you want to say that I want to know retirement. I don't know what question I would be, but something general in that regard. You type retirement, then all of our retirement related topic would come out. You may say that, well, they may be outdated. That's so true. Some of the tax code and everything outdates really quickly, but a lot of them also do not go outdate. They are there pretty steady. So you can get some ideas. Maybe the threshold from one year to another, the number changes a little, but the idea of it is never really go outdate. That is how the taxes is being conducted. So now let's go take a look at the PowerPoint I prepared for you. And I also want to leave the best at the last and stay with me for the next 25 minutes and we'll go through a drawing. I will be explaining to you how the taxes come to play. Now, let me share the PowerPoint. Understanding taxes on real estate gains. So that is our purpose for today, to discover about our firm. We are a pretty old firm comparing to the history of the firm. Majority of the small CPA firm, when they come on board, they stay for 3-4 years, they are gone. And we are 27 years old firm. We have 40 professionals, 12,000 clients on our database. And collectively, of these 40 people, we speak 10 different languages. And we have 5 branches. And the newest one is Houston, Texas. I'm actually in this office today. So if you ever wonder why your background is different from past, because today I'm in Houston, Texas office here. And I served on the National Taxpayer Advocacy Panel for 3 years and providing advices to IRS. I also have these 2 books on Amazon. You can search and buy them there. You can also come to the branch to purchase from our branch. And these books are nothing short of lessons you need to learn when you are in business. So the first book is about starting up the business. And the second book is Growing Your Business. The third one I'm writing today, right now, and it is to expand your business. Just like how Community CPA expands from Iowa to Minnesota, Minnesota to California, then to Texas, right? So everybody's expanding is different for a reason. So the book is all about getting the experience together for you so you can find the path between other people's options. So I always say that doing business is a very lonely game. If you are a business owner, you know exactly what I'm talking about. Sometimes you have this stress you can't even share because even if you share, people don't understand. Your parents don't understand. Your brother, sister don't understand. Even your spouse don't even understand. So those are the things making you feel that you don't have a society that where you can share your worries. Maybe the worry is ridiculous worries, but you still worry. So with that said, these books offer you a sense of belonging because you belong to that group. And these are the people who are just like you, trying things in the dark, then coming to the light, then realize what to do next. So I hope that Community CPA is that vehicle to drive you from where you are to a better place, even better place. If you are still so proud of your accomplishment, you can do even better. That's why we are here to share knowledge. We're here to talk to you. No responsibility disclaimer, and according to our corporate attorney, that's what we need to tell you, and you take advantage of what we teach, but at the same time, take responsibility of what you learn and apply them correctly. Now, let's talk about real estate side of the capital gain. When I sell real estate, what's going on? Long-term capital gain. You know what I'm talking about. When you sell a property, you hold it for more than 1 year, and you have capital gain. You sell for gain, so you know that you pocket some extra money, and that is long term. For long-term capital gain, we all know it has a lower rate than income tax, regular income tax rates, right? So if your income is very low, then your long-term capital gain rate is going down. The maximum is 20%. So this is the general understanding. I know you know that. I just want to bring that out to you. But I want to clear something right here for a land. I call it vacant land, but it can be any land. So if you have a piece of land you bought for $1, when you sell it for $2, and you would have the $2 minus the $1 you paid for, so you have $1 gain. Depends on how long you hold that land. So it could be a short-term capital gain, could be a long-term. If it is short-term, it could subject to regular income tax rate, but if it is long-term, it's capped at 20%, far from 37%, which is the regular income tax rate that we knew, right? So that is to say, the land is so straightforward because you don't depreciate the land. If you bought the land for $1, it stays on your book for $1 forever. So you can sell it for more, then you have a capital gain. You can sell it for less, then you have capital loss, right? All right. So what about we're not talking about land now. Now we are talking about the building, the rest of the building. So we talk about the land. Now we have this building, and gain attributable to real estate depreciation calculated using applicable straight line method is called unrecaptured section 1250 gain. So there's two sets of numbers here. One set is 1250, the other one is 1245. So let's focus on 1250. Basically, 1250 is better than 1245, but it's not as good as a long-term capital gain because it has this rate of 25% at the federal level. So what that says is that if you got a building and your building structure and your basement, those are structural of the building, that is actually depreciated straight line over 39 years because it's a commercial building. So what happened to you is if that building structure is 200,000 and then you have 39 years to depreciate, then every year you're depreciating about $5,000 a year. So you can't really speed it up because it's a straight line. In this case, when you sell for a gain on this property, you are a Section 1250 gain and you pay 25% flat rate. So in some cases, you will still have this 3.8% not capital gain. This 3.8% is what they call the investment tax. It is invented alongside of regular income. Like if you make too much regular income, you pay 37% top rate, then you also pay 3.8%. So that is, you may be saying that, Ying, I don't care what you say because the computer just does that for me. I just want to understand why I'm so surprised with the taxes I have to pay for this building I sold. They were telling me about Section 1250, Section 1245. What is that? What does that mean? That is what I'm here for. I want to explain that to you. So I give you an idea for 1250. This kind of gain related to straight line depreciation. And this kind of gain is limited to 25%. So you don't go up to 37 like the 1245 type of gain. So let's look at what that type of gain is. So qualified investment property generally means any improvement to an interior portion of a non-residential building that placed in service. So that is a QIP kind of money you dumped in. So you may say, Ying, what is a good example of QIP? Remember the leasehold improvement. When you rent a place or when you bought a building, you want to move in to conduct your business, you did a whole bunch of site changes, right? You put in glass doors. I just did that because we have this building in Houston, Texas. It's 4740 Ingersoll Street. We also have another Ingersoll building in Des Moines, Iowa. Isn't that something? So in Houston, this is Ingersoll Street, 4740. This building, we purchased the building. We do interior renovation to make it like a professional office. Our office always have this type of teal green. This is our logo color, it's our theme. And when I come into a building, a site with this type of colors, make me comfortable. This is just interior things we have to do. That is called qualified improvement property. These type of, don't read the property as has to be a building, right? It's just asset. I put in $250,000 to get the office ready interior wise. That is QIP. Now, that QIP, you can do Section 179 deduction. You can do bonus depreciation, folks. And those are fast speed depreciation. For example, in 2024, if I spend $250,000 for the renovation, then 60% of that can be written off. So I write off depreciation a lot. But what if I sell this building, a year later, all of these depreciation I fast processed, it will be subject to Section 1245, ordinary income recapture. There you go. Ordinary income recapture. So, for example, you bought a machine for $100,000 and you claimed $40,000 in depreciation over several years. If you sell the machine for $90,000, your gain is what? Your gain is $90,000, the sell price, minus your book value. What is your book value? $100,000 you bought for, and $40,000 that depreciated away. So your book value was $60,000. So your gain is $30,000. that 30,000, the gain is subject to Section 1245 recapture. That $30,000 gain is taxed as ordinary income. So if you made high income and over $400,000 AGI, your spouse make too much money and you sold the building for 30,000, you know what? You're going to pay 37% on that. On top of that, you have to pay the 3.8%. So this is where you say, oh, hold on, may not be a good idea to actually do this sale. But of course, when I was saying that, and I am actually giving you the pass-through entity kind of look, right? But what if you say that, well, I'm just selling it within my business and it's a C Corp, then you go for 21%. So what I am giving you here is your gain passed through from K1 and went to your 1040, then you pay 37%. Let's take a look at 1250 recapture. We're just going to look at that example. Suppose you bought a building for 500,000 and a claim for 100,000 in straight line depreciation over several years. If you sell the building for 600,000, your gain is what? Is 600,000 minus what is the book value? The book value was the 500,000 you bought for minus your depreciation 400,000. So you got a gain of 200,000. Since the depreciation was taken using straight line, so there is no ordinary income recapture. 1245 out of the window. Out of the window. Instead, the 100,000 gain attributable to the depreciation is taxed at maximum rate of 25%. Then the other 100,000 is your capital gain, long term. So your rate is 20% half. The other one is 25%. Makes sense, right? Makes sense. So now I want to talk about this 3.8% because this is kind of tied with your regular gain. If it is capital gain, it doesn't show up, but if it is regular tax rate gain, like the 1250 and the 1245 and all of these gains, it is possible that 3.8% will come in. Why do I say possible? I didn't say for sure, because it's so much related to your overall income level. So yes, possible, but at least it's there. If you make a lot of money, you for sure will pay for that. All right. So with that, I actually want to say that when you do your planning, when you are selling the building, you really want to click through all of these points I was talking about, right? So now I am going to leave this screen and I want to draw a chart for you. This will make you totally understand how when you sell a piece of real estate and how you can calculate your real damage in terms of tax paying, right? What is your real tax due? All right, so I am coming back to our screens over here. I think I'm still sharing the screen, right? Yes. Let me stop sharing so I can go to our whiteboard with you. So this is the whiteboard, and I hope that you can see it with me, right? So now I'm going to start the magic drawing for the whiteboard. All right, so I want to break those concepts down, right? We talk about long-term. My pen wasn't set up to the width I wanted. So let me redo that. Okay, come with me, okay? Look what I am doing here. So we are going to address 1245, 1250, long-term, short-term. So these are the concept. When we sell a real estate property, this is what you need to know. Now, I am going to draw a house, a commercial property. And I am also going to have this piece of land. So This is the structure, and inside of here is the interior. This is the land. All right. Now, I am going to say that I bought this building. I bought it 2 years ago for $500,000. So the split of my building, out of the 500,000, the structure was 200,000. The land was 100,000. The interior was 200,000. This is how, when I bought the building, it was broken down this way, and this is the value attached to all of these, right? Now, I'm going to use a different color because I am selling it. I sold today. And for $1 million. So if I just allocate my selling price, am I right? I would allocate 400,000 here, 400,000 here, 200,000 here. If I add my yellow number up, that gives me the total of 1 million. Now, each component has a capital gain component, and every component is different. They may have 1245, they may have 1250 recapture, so let's take a look at it. So now we are going to look at the building structure. Building structure, I depreciated this thing for 2 years. So I'm going to continue use the gold color representing how I calculate the capital gains. So 400,000, but on my book, I already depreciate this 200,000 2 years, right? Because it's 39 years straight line. So each year, I would depreciate 200,000 K divided by 39 years. So that gives me 5,128. So I'm just gonna make it simple for 5,000 a year. So 5,000 a year, 2 years, because I had it for 2 years. So that means a 10,000 total was depreciated back. So what happened to the 10,000 when we say depreciated? That means you have already reduced your taxable income from prior year. You already enjoyed the tax deduction, this 10,000. So what is the book value of this structure right now? It is 200,000 minus 10K give us 190K. Right? Book value. I sold for 400K, allocated here, right here. I minus 190K, so I have 210 gain. So now, what is my gain? 10K is from a depreciation come from a straight line. So that is what? That is 1250 section. So what is my maximum rate? 25. 25%. So what happened to my other 200,000? Long-term capital gain. Got it? That's for the structure. What about interior? The 400,000. And because the interior, I'm going to use this side. So I allocated 200,000, but the first year comes through, I already used the bonus depreciation. So my bonus depreciation was so crazy, so I write off the whole thing. So my book value is what? 0. Now, I had $400,000 gain on here. So 200K attribute to section 1245. This is a regular income tax. So my other 200K long-term capital gain. Make sense? That wakes up your thinking. This is QIP. And in here, if you make too much money on your 1040, you are passed through, then you're just gonna add more taxes to yourself, please. 3.8. So that's what happened when you are not straight line, and then we will take back all of the depreciation you did and turn it into the kind of taxable income that make you pay the most taxes. All right, now let's look at our land. Do we depreciate land? We don't, right? Land doesn't get depreciated. We sold for 200,000. So what is the gain? So what is the book value? Still 100,000. So 200,000 minus 100,000. So the gain is 100K, am I right? So that is what? Long-term capital gain, because no recapture. Clean, free of calculation. The rest of these calculations I have on paper are insane, but if you know how, if you understand the concept, then you know how to fill up the forms. You know, a lot of us use computer. So if you know what you're doing, the computer will know what to calculate for you. But imagine if you didn't have this kind of breakdown, or you didn't have the right categorization of your asset, then you may just end up paying more taxes than you should be, right? So this is where we want to bring the knowledge to you, you know, from our home to your home, so you can learn and you can be smarter, even if you are not clients, our clients. So what? You can bring this knowledge to your tax preparer and making sure that they know what they are doing for you and you understand the implementations of taxes. So it's not just all simple long-term capital gain, that's all. No, it's not that. It is a lot more than what simple long-term capital gain is all about. All right, so with that, I will wrap up this afternoon, and I am going to stop stop that, and hopefully you learned something. And if you do have any needs related to our webinar, so I want to go ahead and share this one more time. All right, I am coming back to here. I want to go ahead getting my last slice in for you, because we did do that chart and we understand 3.8. We made our point to say that you need to do planning. Our conclusion is that it is really had more detail than most of people know when you sell a real estate property or QIP property, right? So make sure that you understand it, and we always are here. We can help you, and be sure to know the taxes related to property selling is not a 1 + 1 = 2. It's a little bit more than that. We have on our website these, if you click that appointment button, you're going to see us here, and you can book appointment with us. And our YouTube channel already showed you folks Go on there to learn more. It is really a tremendous place to learn. I even have CPA firms employee, not mine, other firms employee, and follow me regularly so they can become a hero in their firm, because the knowledge we share is definitely understandable. We don't, our whole goal is to give you what we have, and without, without wanting, you do anything with us, you can do it yourself. But whenever you have difficulties to understand and thinking that I just don't want to spend time on that, I want you guys to take care of us. Yes, come on in. We welcome new clients. And here, email Catherine at communitycpa.com. She knows what we need to talk about. She is the weather reporter, and she knows what need to come through on the internet. We always have a lot of followings for our webinars. So one of the huge contributor is Catherine Understand the Market. And of course, we are the only CPA firm open 6 days a week. Seriously, I just checked on internet to see which CPA firm opens 6 days a week, and I could not find anyone but us. So knowing that when you call us on Saturday, there's always a real person there to help you. If you are in one of our locations, then you will be able to visit us, and I will talk to you again soon. Bye bye.